Okay, well, it's 6:01, so we'll get started. There might be some stragglers, but I'll let them as they come. Carrie, you'll be my audio check. Everything sounds okay?
Yes, Joe, everything sounds great.
Wonderful, thank you. So yeah, this will be a pretty brief presentation. I think it's gonna, last month we just kind of talked about general market commentary where we had come in through the Q1. So since it's only been a month, I thought I'd kind of switch gears and just kind of go over a general investments 101 refresher course, if you will. Just talk about the things we like to invest in our process here at FIT. And then we'll leave some time for some questions if you guys have any at the opening. Thanks for everybody for coming tonight. I'm just getting over a cold, kind of on the upswing. So if my voice falters or anything like that, I apologize in advance. So anyway, so let's go ahead and get started. Okay, so today's topic, what is investing? It's gonna, kind of lay it out there, what generally is investing as a concept and how we think about it. It'll be fleshed out in the following slides. How does it work? Just the miracle of compounding interest and how time and diversification are the two biggest friends of any investment. Risk tolerance, that's kind of our bottoms up philosophy around here. That is how we define things, at least at the start. It's really the critical kind of number. We actually assign a number to your risk number. As you all know, you have taken those risk assessments that the advisors provide, and we update that on an annual basis to make sure that we're investing according to your current situation and outlook. Then we're going to talk about types of investments. What we like to invest in here, that universe, and just kind of define how we look at things. And then finally, how those investments are rolled up into a portfolio, how we view diversification as that second best friend of the investor next to time horizon and patience. So those are kind of the 4 or 5 topics we're gonna go over, kind of high level stuff, but I think very educational and just kind of good to touch base on at least once every 1 or 2 years or so. So moving on, what is investing? Basically you're putting your investing capital today for a hope of return in the future or profit. And that's why we do. That's what we do. We allocate into various investment vehicles in hopes of that profit and long-term things. Excuse me, I'm going to admit some people that came in. Okay. Great. Great. Sorry about that. Two things at once here. So, why is this important? Well, you want to let your money work for you while you're sleeping. That's the best thing. Money never sleeps. It can be working around the clock for you as opposed to our normal wages and hourly income. Investment funds that we allocate there to can work for us all the way around the clock, 24/7, 365. So that is the beauty of investing. So it's working when we're, enjoying our leisure time that we've earned and worked so hard for. Investing, definitely not gambling. So one of my the perhaps critical filter that I think of is this something that I can understand? So that immediately rules out cryptocurrency. I've never been able to get a good argument on how that is exactly an investment. The same thing with non-fungible tokens, the artwork on the internet, baseball cards in digital form. These things are somehow assets that we're supposed to invest in. Well, to me, it might be an asset of some sort, but it's definitely not an investment. Because an investment, you need to be able to handicap what might come in the future. And the best indicator of that is what has happened in the past. So we like reliable income streams, strong balance sheets that show profitability, show innovation, and show a quality allocation of capital, putting shareholders first. So we're definitely not gamblers there, as you well know. So why might it be important to invest as soon as possible? This is something I've been trying to pound into my nephews and nieces, since they were about 12 years old, that brokerage account and getting open is not to be touched until you're 60. And if you if you listen to the people that told you, like myself, which I didn't, unfortunately, when I was 18, they could retire at 45. So very important to invest as soon as possible. So here's a tale of 2 investors, same $5,000 investment, different investment ages. One, Tanya above, invested at age 20, Nikki below age 30. This assumes a 5% return, so pretty achievable, very modest conservative return criteria. But that 10 years makes all the difference, So up until age 65, even though it's the same amount of that initial investment. Oh, and then there's 1,200 every year thereafter. Nikki's going to have basically an uphill climb outside of gambling to catch up to Tanya. So, it's almost twice the return, even though it's just 10 years out of 45. So time is everything. So compounding 101. Einstein called compounding interest the eighth wonder of the world. He also was quoted as saying, "He who understands it earns it, and he who doesn't pays it." And that's very, very true. So what's really the nugget is that you're making money on the money you've made. That's the compounding part. Simple interest would just be like a bond without reinvestment, where you're getting your 5% every year, and you take that and you buy things for the grandkids or what have you. Whereas with compounding, you're letting that interest ride, if you will, and continue to grow. So you're making money on the money that you initially laid out and the money that is coming to you in terms of interest. So each year, you're 5% of what you put down and the interest in the year before and the year before that and so forth. And that's how it grows. There's the formula. We'll just skip past that. There's no math for it. So the more time you have, the more money you're going to make. So this is pretty interesting. So here's Jim. He has 15,000 at age 20. This is kind of going back to the last slide, or 2 slides ago. Sally at 35. They both earn 5%. They both plan on taking this money out at age 65. So Jim earns over 45 years, and Sally earns over 30 years. So as you can see, it's more than double with this calculation with that 15-year difference. So again, just to kind of pound it into you, time is everything, but it is the biggest single kind of thing we have in our tool belt. We have that time horizon to outdo the market, or meet the market, or meet our goals. I should say, better way to put it. So yeah, $69,000 difference, so double the 64 that she made. So time and compounding a little more, accelerate your earning power for sure. You're going to get your most out of your investments, and that also includes just staying invested and buy and hold to some degree. As in all we do here, we look for opportunities where we think we can make a better return on capital. Of course, always, but if you invest in good companies, they're going to compound internally. They're going to outdo competitors if they're in a good competitive position in terms of allocating their capital to good investments within the company, new projects, new products, so forth. So you get that compounding effect within the capital in the company they're hiring if they are making a strong return on that investor capital that they've taken under their wing to outlay for us. And that's the key. You got to leave it in there to let it do its thing. You don't want to churn. You want to be very disciplined, not only in your buy philosophy, but your buy philosophy, but also your sell philosophy, just equally as important. So, talked about risk tolerance earlier. That's kind of the key one. There's one variable we had to get and say, okay, this is what we need to invest for this person outside of their time horizon, and we definitely get a risk score. So those risk assessments are so very important and critical to what we do here. So factors which determine your risk tolerance. You have the amount of money you have to lose, if you will. So if you know that you're going to be retired in a couple of years, we want to ratchet down that risk. And if that money is going to be drawn on, we know the corpus is going to be decreased. So we want to be mindful of that and adjust the risk score appropriately so that that will be there. And if you're not adding to it with the body, the principle, then we want to be mindful of that. Obviously, your time frame. Maybe there's a liquidity event on the horizon. That could be pay for a child's tuition, a new vacation home, some kind of charitable legacy gift. That type of thing. Could be anything, but that could impact time frame. And a big one is the emotional ability to handle risk. And I would say my mother-in-law, for example, she's extremely risk averse. She watches Bloomberg quite a bit, and she always told me, "Joe, I want you to make me some money, but I don't want to lose anything." Well, when they invent that investment where you can make a lot of money with no risk, I'll be the first one to tell you about it. But markets would handle that, and it would disappear into the ether because it would be too popular, so that the return would be driven down. But we want to be able to put our clients into investments that we believe in from a financial fiduciary perspective, but also that you feel good about in terms of the riskiness and how those the volatility is a fancy word for the ups and downs of the portfolio. So that risk score really ties into that, how much vacillation you're going to have year to year, and a lower risk score, all things else being equal, will lower that kind of swerviness of a portfolio. And secondly, we also, as an aside, one of our things we pride ourselves on here is listening to our clients and putting them in investments that they ethically believe in. They are aligned with their values, and hopefully, oftentimes our values align with clients, but the clients, of course, govern, and we respect that, and really kind of think that as our guiding light in terms of making sure that we don't violate that. We kind of hold that sacred, that we want to invest in things that our clients feel safe in, and believe in. It doesn't keep them up at night. So types of investments that we look at here: bonds, stocks, ETFs is just basically a mutual fund that trades interday. So there's a lot high liquidity, and there's some tax advantages to ETFs as well. So we will put that in clients' accounts when we think it's appropriate. Alternative investments, that's kind of a catch-all phrase for anything that's not in our kind of bond stock universe. Mutual funds, it could be different hedge funds to private equity funds. Cryptocurrencies would technically be an alternative investment. Here we might allocate to real estate investment trusts. That would be kind of where we would get into alternative. We do some option work as well, to a much lesser degree, but so real estate would be kind of where we would look at in terms of, we're obviously not in hedge funds or anything like that. So bonds, all a bond is, it's just a loan. So this bullet point right here. A bond is basically you, the investor, saying, I'm going to give my money, let's say it's the United States government, for a treasury, bond, bill, note. You're saying, I'm going to give my capital to you for a given amount of time, and for that sacrifice of my capital, you're going to give me a return that is commensurate with that time frame and the risk. Obviously, the United States Treasury is worldwide considered the bedrock investment of all. Everything is based off of that because it has the highest creditworthiness of any investment on the planet currently. So, but a bond is basically, you give them your money and you get a return. Interest is paid throughout the bond life, and there are certain bonds that actually just pay up at the end. They call those zero coupon. A coupon is an old term, basically a little piece of paper you get off your bond certificates. You'd have your coupon, you take that in, and you get your interest for the period. But there are something called a zero coupon bond, where you just buy it at a discount. At the end, you get the difference, and that's your return, your investment. So principal is always paid back at the end life of the bond with any type of bond. You get the principal back and interest at the interim, or like I said, with zero coupon, you get that. So here's just your basic Liberty bond and municipal bond, wherever you want to envision. You give them $100 face value. Typically, it's $1,000 in today's market, but and you say, I'm going to get my $1,000 back, $100 back in 10 years, and you're going to get 2.5% a year. So on $1,000, you get $25 a year. And not to mention, these bonds do trade in the market, and you can buy and sell them. So their values will go up and down. Typically, when we buy a bond here, at least for a short time frame, we plan to hold it to the end, and so it's a contractually guaranteed investment. You're going to put up the principal to buy it, and you're going to get it back at the end, and in the interim, you'll get rewarded for doing so. So we typically like to look at those as the full timeline of investment, something that we're not getting in and out of typically. So yeah, there you go. Over 10 years of this one, you get $25. So you get $25 in interest, you get $100 back, so you're getting $125 over the life of 10 years. So types of bonds. Like I said, at the top of actually at the bottom of the food chain, not the food chain, but the bottom of the pyramid, the most conservative is U.S. government bonds. That is upon which everything else is based. And as you go up this pyramid, pardon me, you will get yeah, higher return, but with that return comes more riskiness. Second bedrock principle I hope you take away today: more risk always, more return always typically means more risk. For a few exceptions, agency bonds, think of Fannie Mae, Ginnie Mae, those type of agencies giving out or selling bonds on the market to fund, mortgage assistance, that type of thing. So agency bonds to fund their mission. Still government. Municipal bonds issued by states, cities, counties, they have tax benefits. No federal tax, and typically if you do it in your state, you're not going to pay tax on a state or city level if you purchase it, if you're in that municipality or in that state, I should say. Excuse me. Corporate bonds, you're getting a little riskier. You no longer have the big taxation power of the government behind you. So this is, corporations, they can be big to small. We stay when we do venture out into corporate bonds, we stay within the investment grade, so the best of that, and the best credit scores along credit worthiness, I should say. High yield bonds, another name for high yield bonds. As you get up here, junk bonds. There's a big scandal with Michael Milken in the 80s. He went to jail for some time misrepresenting what he was selling. But they're risky, they're junky, but you get a higher yield. So people will go out on that yield curve to get that extra juice, if you will, but they also take a lot more risk. So I said, talk about bonds and investment grade to, junk. They're rated AAA is the absolute gold standard. And then you go down on the C or D. D means you're in default, basically. Filed Chapter 11. AAA is the absolute gold standard, so they're the highest credit rating. So you get these are rated by a few agencies in the United States: Moody's, Standard & Poor's, Fitch. So they're constantly monitoring the company's financial statements, or so they say anyway. There was a dispute about that in 2008. When there was conflicts of interest with these issuers, because the people the organizations pay them are the corporations that want their bonds rated. So there's huge conflict in terms of, if people paying you, you want that payment to continue on in perpetuity, you're going to have under pressure to rate them a certain way. So then that's definitely what happened in 2008 in the great financial crisis. So this kind of breaks down between Moody's, S&P, Fitch. These are equivalent here, just a different nomenclature: AAA, A, little a, so forth, going down to junk. Like I said, we are definitely only considered in this range right here. So where we can sleep at night, where the financials are strong, we're going to have no trouble paying the interest, typically twice a year. So that's where we like to invest. So what is the drawback of bonds? Lower risk, so you're going to have a lower return. But if you're risk averse, like my mother-in-law, she is 90% in bonds and 10% in equities. And that's a good place for her. So she's very risk averse. So we do want to pay attention to those grades that we talked about before. Those are they do all the heavy lifting in terms of the rating agencies, in terms of rating those where we can rely on those, for the most part. Now we're getting into stocks and bonds, the two workhorses of any portfolio and wealth management. Equity shares. So stocks, they are volatile. They're going to give you more of that up and down movement than bonds are, just by definition. They don't have contractually obligated payments. So they are traded much more quickly and fluidly than bonds are. Bonds are traded as well intraday, but it's a much smaller market and much less sensitive to the daily news and things like that. So much more bonds are much more quiet, if you will. So why do stocks make money? So basically, as a shareholder, an equity holder, stock owner, you are not getting paid any kind of fixed payment as with bonds, fixed income, if you will. the board of directors, when a company does have income, they can pay it out in the form of dividends directly to the shareholders. So that is one way of getting return back for a stock investment. The second of which is price appreciation. So that's, as you see that stock share pop over time, that should accrue to companies that are investing properly and running their business in a good way in terms of managing that shareholder capital that you've entrusted to them. So, so a dividend, I like to look for firms that have a good dividend history, not missing dividends, and hopefully growing dividends over time. Because that is a direct return of capital to shareholders of profits. So where's the risk? So there's a hierarchy if a company goes bankrupt. The bondholders, and there's different forms of bondholders. I'll kind of leave that out for now, but bondholders are higher in the line than stockholders. The equity shareholders, for taking that, you get the upside, but you get all the downside. So if something goes haywire with the company management, they go bankrupt, what have you, when it gets to court, or there's some kind of settlement, the shareholders are usually out in the cold. They're usually wiped out. Sometimes they get pennies on the dollar, but so that's where the risk really comes in the big picture. So going back to stocks. So yeah, like I said, shareholders not guaranteed any return if the company goes bankrupt. There's no guarantee that shareholders. That's up to the pleasure of the company board in terms of electing to pay a dividend. So companies that pay dividends regularly have that history. If they are to cut that dividend or to stop it altogether, their stock price is hammered down to the depths. The market is not like that. So if you see that history, it's something you can usually rely on outside of something pretty terrible happening to a company's prospects. They are very loath to cut that dividend. So, but it's never guaranteed. There's nothing to contractually obligate them to pay that, unlike with a bond where it is in the definition of the contract. The bond indenture is what they call it. That spells out the amount and the timing of all payments by law. So yeah, and some companies, for instance, Berkshire Hathaway, Warren Buffett, who I've talked about many times, they've never paid a dividend because they believe that Warren believes and his team believes that they are the best allocators of capital. You can't really argue with them. So internally, they believe that they can do more with that money that's been entrusted to them and keep it in terms of the company's balance sheet and retained earnings, that they can allocate that to other investments or existing investments through their management teams on the individual companies that they hold. That'll give them superior return to then let the average stockholder take it out and maybe blow it or try to find a better investment, so they just don't pay that dividend out. And there's pressure on Berkshire Hathaway to pay a dividend because they are so huge at this point that it's really hard for them to find investments of adequate size to move the needle. So Warren Buffett, like I said, he likes to go out hunting with his elephant gun because he's out for big game. Not that I'm a hunter or anything, but he's looking for it's rarefied air companies that he'll look to acquire or or where he can make an investment. That's why he's so big into Apple. The point's the biggest holding because it's top 3 biggest by market cap companies in the world, so it can absorb that investment by Berkshire Hathaway. Obviously, it interests me. So, what's the bright side? Stocks over any 10-year period are going to outperform by a pretty good margin fixed income investments. You're looking at treasuries 1 year right now paying 5%. You go out a couple more percent as you get out into the longer dated bonds or corporate bonds. They'll give you more of a return there. But even if you're talking, just a few percent over time, that is a huge difference. So that's why we allocate to stocks. They're the most easily accessible, widely regulated with the SEC and all kinds of government oversight in terms of accounting standards, things like that. that for the average investor to allocate to. So that's why it's a important part of almost any investor's portfolio. Not everyone, but most. So there's this is kind of getting into the weeds, and apologize for boring, but there's two kinds of stock. There's the common stock, which this represents over here, which is the standard stock that that we invest in, and also there's preferred stock. Preferred stock is just kind of interesting because it is a hybrid investment, form of investment. It's somewhere between a bond and common stock on a company's capital structure. So it basically has features of both. So preferred stock, it's stock, and you can it trades just like common stock, but it guarantees a fixed dividend. So that's almost like a fixed interest payment. So that is they call it a dividend, which it is. It comes out of the company's earnings, but it's guaranteed contractually, and essentially that's a feature of bond or fixed income. So, but it's a stock, and they're higher up preferred. That's where the preferred comes from. They get their money first, and also in the event of liquidation of bankruptcy, preferred shareholders are again ahead of the common stock holders. So, so you get a fixed payment. So that's bond like you can, and it does participate in some price appreciation like stock would when things are going well for the company. But most preferred shares have a call provision. That means that all it means is the company can say, this is getting pretty high price, and we can probably refinance it. We're going to take it out of the investor's hands. So that's something we want to avoid typically. Is we want to know that when we're investing something that we are pretty certain about the time frame. So when we're talking about a normal bond, we know exactly when those things, when the principal's in it can do and all that. With preferred stock and its call provisions, when that can get taken away from us, we don't necessarily like that. So and they don't vote either. So it's just a hybrid, and it's just something to get more capital to a company. Because some people, we're all different. We have our different needs for risk and return, and this kind of is a middle ground and kind of fills up that donut hole, if you will, in terms of investors and financing those companies. So yeah, there's that call. So the company can purchase those shares right back at whenever they unit correct for them. That person in. Okay. So I'm not going to talk much of this. Is just various. There's different classes of stock. Usually, you want to avoid that because usually, what typically that's going to have is maybe company founders, family members getting a different class of stock, and they're going to hold the voting power. So that really diminishes the average investor's kind of voice at the table. So that's not something we invest in. The one notable exception is Berkshire Hathaway. Again, back to Warren, he has Class A and Class B. Well, Class A is the original class of shares, that were traded, when his partnership was formed. I think in the mid to late 60s, and one share of Berkshire is now of that Class A shares. I just checked; they have $607,000. So not a lot of people are going to, get that one share to invest in. So they created Class B, not really for the liquidity concerns or anything like that, but the fear is that other investment companies were going to create these things called unit investment trusts, which would kind of allow like a what's the word I want to say? Not quasi, but a proxy investment. Let's say this company would go and buy one of those big shares, which could afford it, and then they would, on the market say, we're going to slice this up into 100 pieces or whatever, 1,000 pieces, and then sell that out and then make a fee off of that. And Warren did not want that to happen, so he created the Class B shares, which sell for about a little over $400 a share, which allows, the average investor to kind of get the Berkshire. So it wasn't anything real altruistic. It was just more he didn't want the companies to trade and make money off the Berkshire name. Kind of interesting. So yeah, just some general stuff. Most stocks are traded on exchanges. The physical floor stuff, you know, the trading places moved to Ackroyd, they were doing commodity trading, but open outcry type of thing. I actually moved to Chicago in 2011, and that was still going on. Took a tour of the Board of Exchange, and that is, I've heard a lot of wild stories about that. I mean, they used to hire primarily like ex-jocks and guys that you didn't have to know much about investing, but you need to be able to have a strong voice and have a physical presence, believe it or not, to get your stock orders heard and get to the front of that line. So fist fights were not an uncommon occurrence in that open outcry. So but that's all been replaced for the most part. I think there's a few really niche markets that still operate that way, at least in the United States. I know in Chicago, I believe there's still some, but for the most part, it's all more mild-mannered guys like me in front of their computer screen. So doing trading. So that's on all the various markets. So primary and secondary investment stocks. Primary, all you need to remember, primary is this right here, IPO, initial public offering. Primary is the first sale of any stock offering. That's the primary market. Secondary market is where they've already been, is the markets that we trade in, the things that are already out there in the market that are supply and demand are being traded and sold and bought on a daily basis. That's the market that when people talk about stock market, that's primarily it. IPOs are something that, in my opinion, to be avoided. There's a lot of insider information going on and early access to shares. And my wife actually works for KeyBank and supports their investment banking division. And there is just a lot of money flowing around those offerings, and those investment banks try to squeeze every dollar out of those initial stock prices. And if you're lucky enough to get in very, very early, even pre-market, if you have some kind of connection there with an allocation of shares, and fine. But other than that, it's usually you watch in 2-3 weeks. Most of them have lost 30% off of that first day's ebullience. So anyway, we don't have access to that, so we don't think about it. But something to be avoided, I think, for the most part. Okay, yeah, and then here's the market. You got New York Stock Exchange, NASDAQ, which typically tech stocks. Amex is small businesses, smaller public companies. So those are some examples of highly regulated, public, liquid, automated exchanges. And why do stock prices change? Well, in the short term, they'll say that the market is a popularity contest, a vote. It's people voting, with their purchases themselves. And in the long run, it's a weighing machine. So the stock eventually, which makes sense, is going to converge. The price is going to converge at some point on the actual substance, the actual financials of what's going on with that corporation. So, but in the short term, anything can happen. You saw the meme stock craze here a couple years ago during COVID. All this loose capital flying around with the stimulus. You had people with time on their hands and internet chat boards that they could. I mean, it was more or less collusion that wasn't collusion because there wasn't any central actor, but it was these guys that were, when I say guys, I mean men and women coming together and, basically pumping the stock prices up based on zero fundamentals, which is apparently that's their right to do. And, we call it the greater fool theory. The hope is that a greater fool comes along and buys it at a higher price than you are. And eventually there's always a last fool. And that's when a bubble bursts in either an individual stock. Typically, when you talk about bubbles, that's in an asset class like we had with mortgage-backed securities in 2008. So earnings, typically, what does a company make? Earnings predominantly affect what investors think of that. You hear about these earnings reports. Earnings, and Diana can give you a better discussion of this because she's the CPA in terms of what earnings mean and what actual cash flow to the investor. That's what we want. It's cold hard cash flowing to investors, to the common stockholder, rather than earnings. So earnings can be manipulated from an accounting standpoint, but generally they're a good proxy for how a stock is valued. But there's a lot of other things besides earnings from quarter to quarter, how the overall market values the stock. So this just talks about, basically very simple, taking the earnings and multiplying by multiply the value of stock by the shares outstanding, and that's going to give you the overall market capitalization of a company. Like I said, earnings are a major factor, but they're not the only factor. So it's a dark art valuing stocks in general. But what I like to rely on is the history of the management's capital allocation in terms of not a lot of debt, investing in things that actually pay off. Kind of the opposite of the venture capital mindset. Not to disparage that at all. It's just you're on a 10-to-1 basis there. You're trying to get one huge winner and all these 10 smaller losers. Well, we're trying to find 9 out of 10 decent winners. So that's how it's all about putting those singles together rather than hopefully there's home runs out there. We are not opposed to home runs. It's just they're harder to find. They're harder to predict in advance. But singles, not so much. Those are more reliable, and you get the company's history that will allow you to kind of have a little more confidence in that. But we are definitely not putting down home runs there. Those are good too. So exchange traded funds, ETFs. Some of you have those in your portfolio. I'm sure you're more familiar with the term mutual fund. All it is a basket of some kind of assets. We'll just talk about stocks. It could be a basket of tech stocks, for instance, that are in a mutual fund. ETF, same thing. The difference between a mutual fund and exchange traded fund is that exchange traded funds have higher liquidity. They are traded during the day like a stock or even a bond, but let's call it a stock. So they're traded minute to minute, so there's higher liquidity. They typically have, with regard to a mutual fund that's kind of invested in the same things, you have a lower, they're cheaper, lower expense ratio. So that's something that's attractive to us. And typically, so with mutual funds, when you have a new mutual fund investor, it's all cash transactions. I'm buying these shares. Someone at the mutual fund has to go out and get into all the big basket of holdings. Let's say it's the NASDAQ mutual fund, and you have to buy all these Amazon, Facebook, so forth, Google, Meta, all these shares. So there's someone has to do that. So that's expensive. That's the reason why the mutual funds are typically more expensive, and exchange traded funds are not, because the way that they are, these shares trade on a market. So it's not all these cash transactions. It's a lot of, I'll leave out the mechanics, but it's a lot of like exchanges. So shares for shares, this share goes to Peter to Paul to Mary, that type of thing, rather than cash in, cash out. So with that, ETFs typically, not always, they can avoid capital gains more readily than mutual funds. Mutual funds just like we're purchasing, we're buying, and that's it. Those capital gains get foisted onto the mutual fund holder. With ETFs, they can be avoided much more readily. So that's another reason that we view them as a great investment vehicle. So just another word for a mutual fund that's traded on a daily market, and that the price is allowed to fluctuate throughout the day. We talk about alternative investments. I think here's hedge funds, right? You have commodities and different things, and the whole selling point on these alternatives, which is the more exotic ones, is that they are less, leave out the math, leave out less correlated to stocks and bonds. So like what you saw in 2008 and in COVID, stocks and bonds all dropped. There was nowhere to hide. The whole thing on hedge funds is like, well, we zig when they zag. We're down when they're up, not down when they're up. We're up when they're up to a lesser degree, or they're up when they're up more and down less when the whole market drops off. And that was definitely not the case in 2008. I worked for a big hedge fund of funds in Chicago prior to moving back to Portland, and the market lost 28, 29%, something in 2008, and they were down 23%, which is a little less, but still they had some of their hedge funds internally, because a fund of funds is basically a big kind of diversifying your hedge fund exposure among many different buckets, which is in theory a good idea, but you're still paying these extremely massive fees. Just for example, it's the 2 and 20 format. You pay 2% of the asset value every year. And these guys are really good at taking those fees. 2% every year, but they also get 20% of all the upside, none of the downside. Well, that can be mitigated through various things, but that's typically the structure. So they're winning heads, tails, or win, lose, or draw typically in hedge funds. So it's a great business to be in. Just a kind of an anecdotal thing. Let me check on here. Get too far out. I think we're looking good. My friend Warren Buffett, he made a bet with a guy and said, okay, you think hedge funds are these guys are so brilliant, they're the smartest of the smart on Wall Street. You pick any 5 you like ahead of time. So you could pick the best in breed, the most brilliant guys. I will take the S&P 500 index, and we will do this over either 7 or 10 years. And even before fees were even involved, obviously with the index fund, there's not much fees. The performance of S&P just trounced these brilliant, rocket scientist investors. And then after fees, it was even more of a sorry story. And the bet was $1 million to the winner's favorite charity, and have to buy the other guy lunch. But even in advance, picking the best of the best, in which most people don't even. There's hedge funds don't even allow new money in because they're just they're sized to a certain place that's optimal. So that even the most connected people can't even get in. So and that's what this guy had access to, and couldn't beat a simple index fund. So nothing that we concern ourselves here, but like I said, the real estate investment trust, real estate can be can give you that diversification benefit. You can really drill down into certain sectors that you might want to, if you think are going to outperform in the long term or short to medium term, I should say. So something we do consider, but other than that, that's kind of it. Diversification. We're talking about time being the best friend of investor. Diversification is 1A. Let's put it that way. It's right there. So, what's a portfolio besides a grouping of financial assets that you're trying to balance risk and return? These classic 60-40 portfolios. Everyone knows that. 60% equities, 40% bonds, and that's going to, over time, from a risk returns perspective, do very well for the average investor. So diversification is just basically a way to not concentrate on one investment. Don't put it all on one egg. Put it on multiple eggs and in your basket, and that should lower the risk overall of that basket. So, what to invest in portfolios include, tangible assets. Could be a rental property. Your collectibles, for instance, but stocks and bonds are the lion's share of most people's investment portfolios. So, we all think of it like a pie chart, and this asset mix should meet our clients' risk tolerance profile we assess here. So this is just typical. This is means definitive, but just generally, what you have those purple here is cash and other. An aggressive, you might be 75-80% stocks and 15% bonds. To be some of the higher risk tolerance, typically be one of two things. High risk tolerance could be someone that has that longer time horizon, or on the other side of the coin, has capital they can afford to lose or take some short-term volatility with ups and downs. So they have that ability. But other than that, they have that ability to take risks. They're comfortable with that. So that'd be more of an aggressive. But typically with our clients, it's people that are early on in their careers and have that time benefit to able to smooth out the ups and downs and really allow that upside to accrue over time. Conservative, kind of the opposite. You get 75% bonds, and then the rest in equity, 10% in cash. Let's call it. This is form of risk averse. That shorter time horizon, and cash and cash equivalents. That might be a little bit of an exaggeration, but a lot of treasuries and things like that. So cash equivalents, CDs. So the goal here is asset preservation, capital preservation, and kind of staying ahead of inflation when it's not crazy like it was a couple years ago. Moderately aggressive, just kind of in the middle. Diversification. We'll just kind of leave out this securities beta. That's getting into the weeds. I put that in there because it interests me, but it's just gobbledygook probably for most of you. But there's two kinds of risk in investing in a stock or really any asset. You have your systematic risk. That's basically the market. When the market does something wild, COVID, that's the system just breaking down, the global financial crisis, or even the Great Depression, when the stock market crashed. That was the market. There was nothing you could do about it. The other type of risk is unsystematic risk. So that's something that's individual to either an industry, a sector within industry, or individual stocks, something that's just particular to that. This systematic thing, you just get what you get there. We're all living in the same world, but with the unsystematic, that through diversification, through spreading your capital over different things, that when one goes up, the other one should go down, vice versa, more or less. It's the power of larger numbers. That risk can be kind of diversified out, and through that you get a better risk and return profile. So lower risk and higher return. That's about the only time you'll ever hear me say that. That's the one free lunch in finance where you can kind of get something from nothing, because it costs nothing to diversify, really, in the big scheme of things. So we concentrate on that specifically, the eggs in the basket. So and we're in between on this. We don't go out and typically when we get into certain portfolios, we have a diversified portfolio. It's thoughtfully constructed in terms of different sectors that will kind of countervail each other. But we're also doing things on a security level as well, in terms of digging into the individual companies. But we construct a portfolio where you're not owning the whole market, but we have a good basket of eggs, and we keep our eye on that basket of eggs. So somewhere in between. It's not owning the entire farm, but select eggs, I guess we could say. So then this is just an example, let's substitute, say, United Airlines. Let's substitute. A lot of our clients are Nike, Intel people, and they, through their employment, have earned over the years lots of that company's stock. Well, we wouldn't think it would be in their best interest for us to buy more of that stock. That would just increase that concentration risk. So we want to expand that basket and diversify out that, which is a large holding. It is a risk in its own, so you want to diversify that as best you can by getting things in different industries, different sectors, perhaps even different countries. If you have country-specific risk, sometimes we'll look at things that are outside the country, outside the United States anyway. So diversification. So conclusion, compounding, you got to let it sit there. You got to let it work for you, and it works when you're not working. And that's the beautiful thing. It's almost mind-blowing. But Einstein says it's the eighth wonder of the world, and I tend to agree with him. So again, risk tolerance. It's just a measure of what you're comfortable with financially, time-wise, with liquidity events factored in, and also just your personal psychological makeup. We want to respect all of those things. So when we invest your capital, which we take great care with. Again, this is just kind of going over the definitions. Bonds, just think of a loan. When you hear a bond, that's all it is. You're just giving money in your company. You're getting that interest back. Stock, you're an owner. You are an owner in that company. And that's when you hear of a shareholder activism. You get enough shareholders together, and they can make change in a company in powerful numbers. And you hear people doing that. You hear guys like Ray, Icon. He's kind of one of the more famous ones. That will go in there and demand he has 5% of the shares, and then gets other big shareholders on the side to affect ownership change, and he wants a board seat and things like that, so the company is not doing enough to give an adequate return to the company's owners, which are the stock owners. ETFs, like I said, is a shared basket that trades intraday, and obviously diversification. Can't stress that enough. Last month ago, I talked about general market commentary, where we're at. So I want to give a little break from that. Where we're at today, just a couple sentences. We talked about earlier in the year, at the start of the year, 3 or more interest rate cuts to kind of because the work on the inflation has been done. It looks more likely that's going to be about 2 before the end of the year, and it sounds like that's what Chairman Powell is kind of reiterating. He didn't back off what he said earlier, so the market liked that. Inflation is still kind of sticky. The indicator, the gauge that the Fed uses in all their decisions is the personal consumption expenditures index. That's still at 2.8%. So the goal is 2%. So we're getting pretty darn close. But the market likes certainty, just like with earnings. That number was expected to come at 2.7%. Well, came in at 2.8%. So I guess the market being persnickety, these guys, people out in the market collectively, things don't come in right where they expected. They punish the market, and we had a little bit of we had a down month in April, the first one I believe in October. So that there is still some work for that inflation story to play out. Jobs report came in great last week. Less, it sounds bad, but less new jobs than were forecast, which was a good thing. And the market responded very nicely to that and shot right back up. So the economy is extremely healthy. Like I said, I reiterate, the one factor is geopolitical unrest. It looks like there might be some good news on the horizon in terms of the Middle East. You take that with a grain of salt, but we can hope. The Russia and China thing still, Russia is doing some nuclear saber rallying with new additions to NATO, and they're kind of going back and forth with that. So those type of things that you can't predict. You can't protect yourself against by a good diversified portfolio and not trying to outsmart yourself and figure out when these things are going to happen, because nobody knows, especially me. So, with that concludes my formal remarks.